We have a shortened week coming up owing to the May bank holiday, but it should be no less informative for that. Top down, there'll be two features. A Bank of England monetary policy decision on Thursday the 6th of May, and then the latest batch of US jobs data on Friday the 7th. To start with the old lady of Threadneedle Street, economists do not expect Governor Andrew Bailey to announce any policy changes. That means interest rates staying at 0.1%, and the total quantitative easing or QE programme since 2009 staying at £895 billion in total. The most recent change to QE was last November's £150 billion increase, while the headline base rate has been anchored at record lows since last March. Some economists and investors are starting to get a bit edgy about inflation, which is showing some signs of stirring. The Consumer Price Index, or CPI reading for March, showed an increase of 0.7% year on year, and the Bank of England's preferred CPIH measure, which includes housing costs, rose 1%. The Bank of England's view is that both figures are still well below its 2% target, and that even this increase may be transitory, owing to the base effect of the pandemic hit months last year, and particularly the collapse in oil prices that we saw then. Yet some are still concerned. Money supply is rising quickly, commodity prices and house prices are rising, and savers, or at least those who were lucky enough to have not lost a job or been furloughed, have socked away a lot of cash. If that money starts to circulate and the velocity of money picks up, then inflation could follow, given the increase in quantity of money. Or so the theory goes. Over in America, economists will be looking to the latest non-farm payrolls figure for last month, which assesses how many jobs have been created or lost stateside. March came in stronger than expected as 916,000 new jobs were added. America's vaccination programme and easing of local lockdowns will be helping here, and doubtless economists will be looking for another strong number as evidence that the world's largest economy is getting back on track. By the way, also watch for any revisions to the estimates for the prior 2 months, which currently stand at plus 166,000 for January and plus 468,000 for February. Upward revisions tend to occur when the US economy is gaining traction, and the opposite when it's losing it. Bottom up, we still have a busy slate of scheduled company news here in the UK, even if it is only a 4-day week. Large, mid, and small cap firms with trading statements or results penciled into the calendar are as follows, although again, please do note that these dates could be subject to change. On Wednesday the 5th of May, we've two banks, Virgin Money UK and OSB, as well as ITV. They'll be followed by Next, Rio Tinto, Mondi, Superdry, Trainline and Reach on Thursday the 6th, before the week concludes with International Consolidated Airlines and Intercontinental Hotels on Friday the 7th. But the company that looks capable of causing the biggest fuss in the week ahead is Barratt Developments. The FTSE 100 member is due to release a third quarter trading update on Thursday the 6th of May. Shares in the house builder are up 50% over the past 12 months. And panning further out, that leaves Barratt trading within touching distance of the all-time highs that were reached in late 2006 and early 2020. So the timing of this date is interesting, especially as the government has just launched its 95% mortgage guarantee scheme and house prices are surging, up 8.5% year on year at the last count according to the Office for National Statistics. Meanwhile, the stamp duty land tax holiday has also been slightly extended. Barratt felt confident enough to restore dividend payments alongside February's first half results, when Chief Executive David Thomas gave a couple of snippets of guidance for the full year. The main one was expected housing completions of 15,500 units at the midpoint. That compares to 12,604 in the year to June 2020, but still lies below the pre-pandemic peak. It'll be interesting to see if Mr. Thomas makes any comment on pricing, where the private average selling price was just shy of £320,000 in the first half, and also whether there are any signs of cost inflation. Finally, analysts will look to three more items, as will shareholders. The net private reservation rate, which was 0.77 units per week on average across active outlets in the first half. Forward sales, which were £3.4 billion as of December. And then net cash, which reached £1.1 billion before the payment of the dividend at the end of the fiscal first half in December. I hope that you and your families are all in good health and good spirits. Thank you for listening, and I look forward to talking to you again next week.